Thanks, Britt, and welcome everyone to the session today. My name is David from Forma AI, and I will be hosting today and guiding the discussion with our guests. The title for today's session is How Finance and Revenue Leadership Aligns on Sales Targets, Quotas, and Compensation. When it comes to setting sales targets and aligning on budgets, revenue and finance often bring very different perspectives, but both are essential to getting it right. And so in this session, my guests will discuss how they navigate these critical conversations, how they find common ground, and ultimately drive business success together. And so with that, our speakers will now reveal themselves and turn their cameras on. And I'd like Mark, Steph, and Brian to just introduce yourselves to the crowd. And how about we start with Mark?
Sure. So my name's Mark Harris. I'm SVP of Go-to-Market Strategy at ZoomInfo. Been there for close to 6 years. Before that was in private equity at TA Associates and Bain, working with mostly private equity-backed portfolio companies on growth initiatives.
Great. And Steph?
Hi, everyone. Steph Lane. I'm at Klaviyo. Been with Klaviyo for about 3.5 years, going on 4. I lead the money team here at Klaviyo, and we're all about smart money moves, incentivizing our partners and our go-to-market team to, grow the company as well as smooth payments to fuel our business. That means I lead payroll, go-to-market compensation, and treasury here at Klaviyo.
Great. And Brian?
Yeah, my name is Brian Bolt. I've been at Red Hat as a senior director most recently for the last 6 years. I'm a senior director in corporate finance. Prior to being in the role that I'm at right now, I was headed up our incentives department, sales incentives department. For that, I was in corporate finance before as well, managing our corporate spend. Been in finance for most of my career.
Great. And so with that, I'd like to kick us off and kind of take a little bit of a higher level look at the sales planning process. And I kind of wanted to open up the discussion by asking you guys, from your perspectives and your experience, how do revenue and finance teams approach sales planning? Perhaps you can even look at it at the beginning of the year when we're starting a brand new fiscal, but what are the key priorities from both sides of the table?
I'm
I
happy
can
to.
jump.
Oh, go
Oh,
ahead.
go ahead.
Go ahead, Mark.
All right, I'll take it. Yeah, from my perspective, a lot of this it is a really close partnership between sales, finance, sometimes different groups as well, and often starts with finance as far as cascading down a relatively top-down target, and then partnering together on how that splits out between new business, account management, by segment, by time period, etc. I'd say what we bring to the table is more of the bottoms up view. What is our headcount? What is our productivity? What are the trends? Things that we expect to change throughout the year, new product launch, etc. And ends up being sort of a reconciliation of the top down and the bottoms up view. And that's the way that we ultimately land at something that obviously the trade-offs we're thinking about is we want to set an ambitious enough target that we are all chasing after an outcome that we'd be really happy with. And but also not so high that we are disincentivizing the business and driving attrition in sales.
But
And
Yeah,
Steph,
I think
would you like to add to that?
yeah, just to double click, I think it's, looking at where we've been and where we're going. So looking at the prior year or years of plans and planning, and then where is the business going? So it's really aligning to that. Are we doubling down internationally? Are we launching new products? Are we focused on retaining customers? Are we focused on acquiring new customers? And then creating those plans around each of those teams to incentivize them to get after it.
yeah, and we're kind of the same way here at Red Hat. I mean, so we're wholly owned by IBM, so we work really closely with them in our 3-year financial plan, and then every spring and then every fall the formal financial plan for the following year. And so for us, it's really just translating that plan that we've already kind of aligned on with them, and our expectations for revenue growth and cash flow and things like that, and then just translating that into a sales plan that achieves those targets.
Right. And Mark, you alluded to the fact of kind of the bottoms up approach and looking at it, building bottoms up. comparing it with top down, and this is kind of an open question to the three of you, but what, in your experience, have you encountered situations where that gap is huge? And how do you address it in I guess, many ways in terms of communication, but also in terms of where do you end up settling between the top and the bottom down?
Yeah, that's a good question. So when I think about bottoms up, you can think about it as per seller, you can think about it per segment. Sometimes we even look per account, and some modeling of what we expect them to do over time. Although, to be honest, sometimes there's diminished or even negative returns to that level of granularity. So tend to look, by segment and by seller, are two of the more helpful ways to look at it. Yeah, often it doesn't tie out when you do the top down bottoms up view, and especially the more granularity you take, the more variability you're going to have. You had 3 attrits in enterprise and overperformance in mid-market, and things aren't going to match up. A lot of times I think that's really important to recognize and see it as kind of a negotiation between the two. So not, it's an iterative process, I guess, is what I'm getting at it. And especially with that granularity. So in that case, okay, probably the mid-market number goes up and the enterprise number goes down. Otherwise, either in aggregate or for any specific one, often, like I said, it's a little bit of a negotiation of what we think is achievable. Trying not to be punitive, but also not just waving the flag, and striking that balance. But then, we tend to look at it in terms of what do you have to believe, right? So, okay, you've got this gap to make up an enterprise. How are you going to do it? You're going to do it through large deals. Okay, what's that ASP? How many deals is that? Up funnel, what does that imply? And then, you assess the feasibility of it, and you're placing a bet somewhere. And so it's just a matter of trying to clarify as much as you can where those bets are and how realistic they are.
And for Red Hat, 75% of our business is subscription based, right? So you have a renewal that you're going to be drawing upon, and what kind of expected growth you want to see out of that renewal. So we literally will do it contract by contract, account by account. And kind of like Mark said, you'll look at all those accounts, you'll look at the industries. Are there trends in certain industries where the growth in that industry is higher or lower than others, like telco or edge or other things like that? We'll look at those as like key market areas that we're going to focus on. And then after we've kind of determined all of that, you say, okay, well, what's our revenue need to be? And what does our renewal look like? How much new business do you need to drive out of those renewals? And how many new logos do you need to actually tack on? And then you marry in the products. Like at Red Hat, we have 3 main product lines. And so we look at those product lines. We look at customers that might be, say, a Linux or RHEL customer, and we'll say, well, it's easy to cross market to them. Should we sell them Ansible? Should we sell them OpenShift? We need to cross sell and do a lot of that kind of expanding within our existing customer base. So we look at it at that renewal, that account. You look at, are they one product customer? What happens if you make X% 2 or 3? And how do you back into that math basically to support the revenue goal that you need? But it all starts with the renewals. Like, you just need great renewal information. For us, 75% of our business is kind of come out of that base, and that's how we attack it.
Super interesting, Brian, because we're more of a month-to-month SaaS business where, every month is different. Our ARR is always all over the place. And so we don't really focus on renewals. We focus a lot on land and expand.
Yeah.
And then I would just say, tying to the corporate goals of where the business wants to go. So for us, it's moving from the SMBs and the entrepreneurs and our product is an email and SMS marketing platform. So moving up market to mid market and understanding the needs of that market compared to the needs of the smaller, smaller businesses that are just getting their feet on the ground. I will just also add that there is always going to be a gap between what finance wants and what sales is asked to deliver. And so it is a little bit of an art and a little bit of a science, I think, as Mark mentioned, to kind of pigeon that into the actual plan and actual goals.
And Steph, when you're looking at it like a month by month basis like that, are you, in your experience, have you had times where, like do you need to be in touch with finance and sales need to be connected on a monthly basis? Or assumptions changing live that you are then implementing and changing perhaps in targets or the plan on a monthly basis?
Yeah. I think if I could be very transparent with Klaviyo, we only launched H1 quotas this year. So we developed the plans and we launched just our first half quotas so that we can learn how the sales team is doing with new pricing and other products. So for us, yes, we're looking at it monthly. We're just about to launch the H2 quotas, and then how stretchy is your second half? As I mentioned, we're an SMS and email marketing platform, so we have certain peaks and valleys in our business, such as Black Friday, Cyber Monday. So think about all the emails you get around Thanksgiving and Christmas that you're just getting flooded with it. So our customers, upgrade and higher demands during that period. So I would say absolutely looking at it constantly. And then and this is the first time in our evolution where we said we have to lock into just the first half quotas, and then we're going to reissue second half quotas or new quotas just so that we can learn from the first 6 months of the business. So a little scary and a little bit of a heavy lift for our team. But yeah, that's us trying to learn on the fly.
And just to follow up, another follow up to that, in terms of the field and the reps' perception, is there any skepticism when you are going on a shorter period and saying, "Hey, they're just going to jack up my quota in H2"?
Yeah.
Was that a fear?
For sure. I think we've relied on our sales leadership to really message this properly. I would say as the administrator of the plans, as the one calculating compensation, I'm quite nervous about when we actually roll out the quotas to see what the impact is going to be. And of course, we want to stretch in the second half. So we don't know how the reaction is going to be. I think they were mystified a little bit by not getting a full year quota.
Right.
And so I do expect we're going to have a lot of office hours and a lot of conversations around how to speak to those H2 quotas.
Some of that I
And
think is inevitable at the business or team level, whether it's semi-annual or annual quotas, the idea that overperformance is going to lead to higher numbers. We definitely try to emphasize and re-emphasize we don't do this at the individual or team level. And that's important so that, if you're actually hammering outliers at the individual level, that would definitely be seen as punitive and unfair and probably drive a lot of lack of motivation.
And Mark, I actually wanted to follow up on something that you were mentioning before in terms of that iteration between top down, bottom up. How much time do you, in your experience, book for all of that iteration when you are planning? Is this exercise starting like 6 months before the fiscal and you're iterating down to the wire, or when can people expect to start that?
So at least a few months, because the biggest dependency, ideally, there's an ongoing version of this too. I don't know if you can hear me. Looks like my screen
No, we can hear you clear.
is frozen. Cool. Yeah, ideally, there's some sort of ongoing version of this too. One of the big dependencies on this is resource planning, right? So if you're going to make a big bet on a given business, then making sure you're actually resourced toward it. The worst thing that can happen is you decide, December 31, that you're going to put all your chips in X region or business unit, and you're not actually staffed or otherwise resourced to do that. And so for us, resource planning is a really important function in a year-round exercise. But yeah, the most direct, I think, realistically, it's a few months to set the targets. But ideally, you're deciding between 8% and 10%. You're not really like going crazy starting from scratch at that point.
Yeah, and ours is pretty similar. Right around September is when we really kick off in earnest for the following year. And we take a little bit, maybe not really a different approach. It's probably pretty similar to some of the other companies, but we really try and make sure that the sales senior leadership teams for each of the major areas are really, really closely aligned to what the corporate goals are. And because from our perspective, we actually start rather than doing kind of even though we use renewals, which is kind of a bottoms up approach, when we set a lot of those targets, we start at the top and work our way down. And then those sales leaders all collaborate together to build one big comprehensive plan that is very much their plan to get to the targets. And even though there may be individual quotas set at the higher levels by finance and go-to-market finance, the lower you get, the more heavily involved the sales leadership teams and the sales management teams are. And they start setting each of those individual quotas. So in some ways it's different than what Mark was describing. For us, the lower you get, the more individualized that quota actually gets, all the way down to the account in individual levels. So but the good part is they have them all aligned at the top for what the overarching goal is. And there's a series of kind of horse trading events that happen from September to late October, where they're switching back and forth between the geos or between the enterprise and commercial, things like that. In order to make sure that our overarching plan aligns to that revenue goal. Because our revenue goal is one big revenue goal. We don't have a geo goal. They can swap between, Asia Pacific and EMEA, et cetera, to get there.
We had a question in the chat that I think builds a little bit on what I asked earlier in terms of I was talking about, what do you do when there's a giant mismatch between, finance and sales? But I think this question is perhaps putting an even bigger spotlight or a more intense one on asking, what happens when the board / senior leadership, their top-down target greatly exceeds the bottom up. How do you navigate those waters when it's not just finance you're talking to, but it's actually coming from the C-suite?
Yeah, I can start on this one because we have this all the time. There's always a stretch goal built into even near-term goals for us. And a lot of ours, it starts with, what do you need to do it? Right? Like, what are the resources that you need to do it? Is it heads on the ground or boots on the ground? Or is it, incentivizing certain things over others? Or, what exactly is needed in order to actually hit that? I mean, is it an investment in technology, investment in resources, an investment in the actual compensation side of things? And that's where we start now. I mean, at some point in time, the gap may just be too big, right? And that does happen. I think, that what we have to do is just have a realistic resetting of expectations. If you get to that step, right, you just say, hey, just say 20% is just not achievable, but maybe 17 is. But it goes back to, what do you need to do it, right? Like, I mean, I think if companies are willing to spend money to make money, that tends to be something, at least at Red Hat, that we're pretty open to. Revenue is king, right?
Queen.
So yeah.
Revenue is queen. Just kidding. Cash is queen.
Yeah,
Revenue is king.
revenue is
You can have-
royalty. Revenue is royalty. Yeah, and I mean that's ultimately we really want to get there, and the margins are not an afterthought. They're very important, but revenue is definitely the top of the ladder.
And I think SLT is SLT for a reason. They're supposed to put those big, lofty, dreamy goals out there and make you think differently about how you're gonna hit them, right? Brian, I love your point, because it is, what do you need? Sometimes it's a problem within finance, right? Sometimes the contracting process has too many blockers or too much friction. Sometimes, we're launching CPQ. Sometimes it's the systems that are preventing them from moving faster or up market. So I think you asked the right question. Like, you put it back on the team to say, what is stopping you, what is preventing you from hitting this number, and then can we bridge it? And it might be no, like you said, it might not be feasible.
Yeah,
But
and
SLT is there to stretch us, right? They're there to make us think outside the box.
yeah, and I noticed in the chat there was a mention of AI and incorporating AI and holding headcount flat and things like that. That's on everyone's mind, right?
Yeah.
I mean,
Yeah.
it's absolutely, how do you make it more productive? How do you cast a broader net with the same number of people? And I think that's where AI really comes into play. And it can come to play and Mark, you mentioned segmentation, right? Like, it's really important to get your segmentation aligned and right. And I mean, there can be AI and analytics, advanced analytics that get built into that process that make that process easier for people. But AI is a huge part of what we're trying to incorporate, not only in the corporate space, but in our go-to-market operations.
Sorry.
Go ahead, Mark. Yep.
I'm going to say on some of the previous points, and would echo everything said about the stretch targets. No one likes being surprised at that level. And so if there's one thing to do, if you're going to miss, get ahead of that messaging there, because at least if you're going to miss, you want to show the competence that you saw it coming. And so, wish casting continually, that tends to backfire. Also definitely agree with the point around like go with what, the ask for what you need, that will get you that revenue number. Otherwise, you're sort of giving a problem without a solution. Now, it might not be a solution they'll agree to as far as the budgeting for that, but at least you come in with it. Only other thing I'd say on that is the bar for that is quite high. If you're asking for some $1 million, you had better have a good idea of where you're deploying it. What is the payback and why is that the right bet? I've seen that done really well. I've seen that get torn apart at the board level.
Related to that, we had a question I think that was interesting in terms of what are your views on overassign on the sales target versus the finance plan, and how do you navigate those decisions? I guess in your experience for everyone, how much do you overassign to the sales field? What is kind of rule of thumb, or do you do that at all even?
Yeah, I can start on this one. Yeah. I think over deployment of quota is I don't want to say it's standard practice, right? I don't know that all companies do it that way, but I know some of the bigger ones do, at least in our industry. And it depends on what the gap is as to how big that is, right? Like how big is the gap to where we really want our performance to be. But you really don't use it to press the sales team necessarily. It's really more of a mitigation tactic, and it's a risk mitigator. The more you incorporate some hedge into the numbers, the more flexibility you have if you miss them. And I go back to, with our business being subscription business, timing is a lot of the story as well. You have to sell, and you have to sell early. The earlier you sell, the more of an advantage that you have in revenue recognition. And so for us, we want to incent people to do that as much as possible. But if a deal slips, it can mean millions of dollars in a quarter and for the year. It's the same deal, right? It just slips from month to month, and it can mean millions. So for us, it's really important to have that hedge in there for risk mitigation. But we will over deploy to some extent, any period, any year, especially
Yeah.
early.
Yeah, I think there's definitely some standard practice there. Everyone does it differently. There's also just the different levels of the field. So frontline being over deployed, but then each level you give a little bit of that relief closer toward the overall business goal. If you go to a manager or director and they have the same number as the sum of their individual contributors, what they'll say back is, so you need every single one of my sellers to hit their quota in order for me to hit mine. No, that's not actually how it works, because some people go over and some go under, and that can still get you to your number. But the point, carries some weight as far as the bigger the book. One, the harder it is to hit that number, obviously, and two, you don't get that upside, right? So like you've got that big number at the rep level. They have maybe a big number by their standards. They have the opportunity to way exceed and hit accelerators. The bigger your book is, there's just not that level of variability, and so they're not getting into their third accelerator rate, let's say, with the same kind of frequency, or at least those gates have to be managed to make that more possible. And to that same or similar point on the accelerator piece, that's often sort of a counter lever that we play with is, hey, you've got a higher number, but there's a lot more upside if you hit it. But you have to look at those two things in coordination. Otherwise, it's just a higher number, higher bar in order to get the same outcome.
Yeah.
Brian, you brought up AI a little earlier than I was intending, but I think it's great that we jump into it now, because there was a question that was, I think, very well related to that in terms of productivity. So you mentioned that obviously AI can increase productivity, but what if, I think the audience might be interested in how do each of you guys measure rep productivity? Like what metrics do you look at? How do you even know where you are today before introducing any AI tools?
Yeah, for us, I mean, there's think of any of the big productivity metrics that you see, right? We'll look at anything from an E to R metric to a headcount for revenue metric. We want to make sure that those metrics are, and quite frankly, overall expense, including commissions as a percentage of revenue, is probably one of our biggest ones, right? Like when we look at it, E to R is huge for everything that we do. We plan all of our expenses with kind of target or benchmark rates, whether it's corporate, whether it's R&D, or whether it's sales. And so for us, we just need to make sure that our expenses are growing at a rate that's slower than our revenue growth, and making progress in productivity space. all year. The hard part about it, I think, as we get into a space where a lot of companies really leverage AI to make their field more productive, is how do you do that in a smart way, right? It's how do you do that where it's actually like leveraging the investment dollars in a smart way to ensure that you're actually driving more sales. It's not just about making someone's life easier or better or faster or less people, right? It's about increasing your productivity per person. And that for us has been really critical. The hard part about that for a lot of people, I think, is we don't know exactly how to do it just yet. I think a lot of companies are trying to figure that out. It's like in finance, it's not as hard. You can say, oh, well, this helps me forecast by doing analytics or building, automation into reporting or whatever. For sales, a lot of times it's, face to face, and there's a lot of uh, there's the opposite of AI involved in our sales motions. So a lot of times it's just segmentation, targeting. How do you get people to really recognize those higher value customers faster?
I think we're just scratching the surface on AI, right? I think
Yeah.
we're all still
Yeah.
learning and, even trying to figure out what the right tools are to deploy and across all the functions. Yeah, I can't say we have a good solution yet either.
I mean, the answer could be no to this, but I'm just curious if the three of you, has anyone implemented any tools that have been like, what kind of efficacy have you seen?
Around
Yeah, go
go
ahead,
ahead.
Mark.
Around performance management, we've done some. So if it's, what I guess to step back, like when I hear productivity, I just think dollars and cents, as far as like sales productivity. So, how do you measure it's dollars sold over a certain period? And really it's, adjusted for ramp status, it's adjusted for team segment, whatever else it is. The ramp status, by the way, is really, really important. So we split out, we've changed the lines, but like 0 to 3 months, 4 to 6, 6 to 11, 12, 23, 24 plus. Because you do see like meaningful differences. And the last thing you want to do is compare people across those ramp stats to say someone isn't good when in fact they're just new. So that's one point, I guess, like, thinking about sales planning. Literally, in my mind, the whole thing could be boiled down to how many sellers you have, what is their ramp mix, and what is the baseline productivity per seller. If you know those three things, like you can project the sales of your business. And if you are flat-footed on that, you don't have enough sellers, attrition went up, or you have enough sellers, but they're all brand new and your ramp status is bad. Or obviously, if just the baseline productivity drops, those are the, like, if there's three numbers to think about in a simple way, I think it's really that. Just back to the AI part. So like performance management. So we have some scorecards that we use that pull in a bunch of metrics. Most, at the center of it is just their sales numbers, but things like win rates and ASP and, activity metrics, things like that. Where we've incorporated some AI in an interesting way is we have an LLM that will spit out like basically an explanation of someone's performance. So like for the new business team, we have some, I think, pretty neat scorecards that kind of look at a seller and, okay, how do you perform relative to expectations on win rate, on ASP? What does that lead to? Lots of other things. And then we built some kind of test examples, now can spit out and say, hey, looks like you're doing this well. You might be holding out on price too much in these types of ops. You should be leveraging this tactic to do X, Y, Z. It gets a lot more engagement. And you put like a really complex, a messy Excel in front of a sales leader versus like, here's 3 sentences. So that's been a pretty interesting use case so far.
Sounds like I need to set up some time with you, Mark, and figure out how you did that. We
We
are quite
had
behind
someone
in this
figure it
space, I
out. I
would
can't
guess.
say it was me.
Yeah, I will say like like we're just scratching the surface, as I said, and I think that the focus has been a lot on the AI relationship and the conversations and the talking to practicing things with a bot, and which is pretty basic AI probably, but like preparing yourself for these conversations, especially when you're new and you're ramping, like what questions could come back, and just using AI in that fashion. They're probably using it more than I know. I don't know exactly what the enablement team is using, but I don't think we have a very deep bench yet. It is a high focus though.
And staying on the topic of quotas, we had a couple interesting questions come in, and I wanted to pose to the group. Kind of an interesting question around: have you guys, in your experience, ever had an example where you're lowering the forecast during the year, and to the point where you're actually going to lower the quotas. I feel like that's maybe a bridge that isn't crossed too often, but has it ever come up, and what makes the decision to say, yes, we'll lower?
We've had that at Red Hat in our services organization. So services is about 10% of our business, and during the pandemic, it was a perfect example. We weren't able to deliver, right?
Right.
So I mean, our quotas have been set. Just the timing of the pandemic, everything was, going into the year. I don't think anybody saw the back, or really even the second through fourth quarter of the year happening the way that it happened. And so we made a lot of adjustments on the fly with quota reductions and actual reductions. Not only to our revenue and sales projections, but just to our quota. Mostly in the services, again, we had a pretty good bolster of subscription revenue coming in, but we definitely had to do it there, and we pivoted really quickly to do it. The hard part was you had no idea when to turn it around, and so we struggled with that as we closed out 20, and then entering to 21, it was even more difficult, right? Like the vaccine had just been introduced, and we were struggling to say how quickly does it come back. And especially when you have to look at that on a global basis, it was definitely a challenge. But we did that. We did that for our services organization in 2020.
Two thoughts on this one. We ran into this predicament in the second half of last year. And instead of reducing quotas, given the impact it would have on the morale, we actually increased and you guys probably know the words better than I do, but increased that each deal had 1.3x versus 1x. And so we added a little cookie per se on top of what they were closing, so that they could still reach that quota, but they got a little bit more credit than they would have got if it was just dollar for dollar per se. And then the other thing I would say on that is we haven't reduced quotas, but we have reallocated resources and maybe changed a plan to help build up areas that were really behind on their quotas. And so instead of reducing quotas, we would just put more resources behind it to get the team where they need to be.
Yeah, we've never lowered quotas overall. We've done exactly what you just said, Steph, the attainment multipliers, which is a
Yeah.
really I'm a fan of when it's needed in situations like that, but it can also be just a spiff. What's good about it too is you can be really specific about what you want to incentivize. You can say upsells over $25,000 with this product, whatever. You can gamify it, and you can do it for a month or 3 months, whatever you want to do. So there's a lot of flexibility there. It's also, I guess, less of a public admission of failure than just lowering quotas and saying, "Whoops, we set that too high." At the more granular level, we do make some adjustments. In the past, I think we've been a little trigger happy of like, oh, this math says really it's account driven. So like for our account managers, that's really where this comes into play. Let's say you get a huge swath of accounts brought into your name mid-period, maybe your coworker left and re-quota. That's something we now try to save for like pretty extreme cases. We have some ways to get around it. So we really want to avoid raising people's quotas, even if there's a good reason for it mid-period. I'd say at the leadership level, that's where it's most common and most justified of like you absorbed a new team. So your quota went up. But that's different than just saying do better because we think you should do better.
Yeah, we've used the multiplier approach. Actually, if you see a market opportunity that's very time sensitive and you don't want them to wait, right? Because if you're going to miss the opportunity, if you add that multiplier, that you'll incent them to jump on it now, jump on it hard, and maximize their sale opportunity in that one. So that's been pretty effective for us for multipliers. And like you said, Mark, it can be very prescriptive, right? Like you can say, oh, I'm gonna go after this product. I'm only going to incent on this product, or only going to incent in this area. We've been pretty successful doing that too.
I wanted to close out the conversation with actually a question I meant to start the quota conversation with, but it's top of mind because actually, a customer in the past had asked this. He was head of finance and he was responsible for target setting, and point blank asked me like, is this common that finance is literally owning the number, but also owning the rolling it out to all the go-to-market leaders who typically owns it in your experience, the final quota number? Is it finance? Is it usually sales ops or a rev ops team? What is most common out there?
Quota itself, for us, sales operations manages it. So they are ultimately the ones that are managing that within the tool, within our our SCM and our sales performance management tools. Like they're the ones that are technically managing it. For us, it's again, we have a bookings goal and we have a revenue goal that are not the same, right? They're very different. So that bookings goal is the quota that we're talking about. From a revenue goal, clearly it's finance that manages it. And then that bridge between them is what we call our go-to-market finance organization. They're the ones that make sure that that bookings target, all those quotas translate to a revenue number, which is aligned to our target. So for us, it's those three organizations. Like where I'm at is very finance. It's corporate finance where the revenue targets all day long. We report on some of the sales and bookings, but that's about it. Go-to-market finance is where all the sausage is made. It's the mixing of the two numbers. And then operations works almost exclusively in booking space with the teams directly.
That's
Is
the
that the
same at
same for you,
Klaviyo, I would
Steph?
say. Yeah, it's the same for us at Klaviyo. I think that there is some debate about when finance should be directly involved. After the initial quotas are set, and things shift around a little bit, but it works in the same fashion that Brian illustrated for us here at Klaviyo.
Yeah, agree with that. I've seen a few versions of it, even in the same company. The way we have it delineated, yeah, is there's finance with responsible ultimately for the top down targets. We set the quotas and it down to the individual level. There's a separate compensation team that owns our sales compensation platform that actually pushes it through to the reps and manages it. And there's a ton of work that goes into that, but it's a pretty distributed model. Obviously, a lot of dependencies, so we also have to work well together.
Another very specific question, but I thought I'd throw it out there to the group in terms of something that's coming through the chat. So a scenario where we have multiple teams with various headcounts and individual revenue goals for those teams. But those revenue goals are contingent on certain sellers in each of those teams. What happens if you're not able to get that headcount in each of those teams? Do you stick with those individual revenue numbers, kind of raise the bar for everyone on those teams? Or in your experience, should you just be distributing it amongst the whole, across all the teams, kind of raising everyone very slightly? What is the approach that you guys would typically take?
Try to model it in as best, like the goal point earlier of ideally you're sort of resourced at the right point going in. If you're in a really high growth, like in terms of headcount, if you're planning to grow a lot, there's a lot less burden to over quota because you're about to get a lot more street quota coming in the door. The reverse, if the org is flat and you just expect some attrition, it's gonna be hard to backfill. Then you need to model that in as like some of that quota might evaporate. So I think the headcount growth is the biggest thing, aside from just good planning. But no, it would be hard to say like, hey, we didn't make some hires and so your quota went up. That would be a very tough sell.
Yeah, same. We try to make it as detailed as possible as we're assigning the quotas to the individual rep level and individual territory level. So we build that in to the extent possible. We do. It's actually one of the questions that came in on the chat that we at Red Hat offer if someone leaves, say early in the process or in the middle of the year, typically we offer what's called an account coverage bonus. And that account coverage bonus goes to the other reps that are covering for that territory. So if they sell into accounts in that other territory, they'll get compensated for it. And it's at an accelerated rate over a normal quota. So it's for us that's been really effective. We don't like to use it, to be honest with you, because you want to be fully staffed. There are a lot of rules around it. But that's what we'll do. But to the extent that we can, we like to plan it into the original quota setting process. Make sure that there's some level of attrition built in.
I'd like to move the conversation now to compensation plan specifically. So now, we've covered a lot in terms of actual quotas, but let's talk a little bit about, often obviously finance has their own metrics and their own, essentially goals. What ends up going to the field might not be exactly the same. Obviously, top revenue targets might be there, but how do you make sure that the comp plan is aligned to everything that finance has as their metrics and their goals for the year? It's a big question, but how do you bridge the two, essentially, the comp plan to actual finance objective?
I
Yeah,
think your
it's
comp plan needs to align to the same finance metrics in some sense, right? Sorry, Mark. So I think, last year retention was a big thing for us, right? And so we created a net retention measure in our plan. And so I think they have to align. I don't know how they wouldn't.
It has to
I
be
don't
the
know, Mark
exact
doesn't
same metrics, I guess, Steph.
doesn't
So,
have to be the exact, yeah,
okay,
it
can
doesn't
you give
have to be the exact same
examples,
metric.
yeah, of where it might not be the exact same, but maybe is it kind of an indirect relationship?
We had gross churn and net retention at one point, kind of targeting a similar behavior. Mm, it's a good question. I actually don't have a good example.
Yeah, what about just even the kind of understanding of the reps in your experience, like when you're designing that compensation plan, how well aligned do you think the field is in terms of understanding, their quota and what those objectives are?
Yeah, I can speak a little bit to that. Like for Red Hat's process, like what we do is we actually meet with our sales leadership team every month, and we go through a series of performance metrics with them and KPIs on the incentive plans and how they're doing. And we talk a lot about what's working and what's not. And it can be anything from, a couple years ago, we experimented with a knee in the payout, right? Where you weren't paid as much, lowering your attainment, and it ramped up a lot. And what were the pros and cons to that? Fundamental design elements, leverage factors, what are you going to incent for, by product, by service, et cetera. And for us, it's all about those iterative meetings that we have with the leadership. Now, one of the assumptions is that the leadership really has its pulse on the field and what the field really wants and understands and really likes and doesn't like about the compensation structure. And for us, we're pretty agile. I mean, we can handle it sometimes with spiffs. We actually did that with some kind of flaws in the plan design that happened a couple even as recently as 2024, where we designed in spiffs that made sure that we finished the year out strong because of a design element that was not really intended when we initially cut out the design. But it's all about making sure that they're aligned with it. As far as education is concerned, something that we did this year, which is new, and we were talking about AI earlier. We at Red Hat we operate on Google Suite, and so we leverage Gemini and a function within Gemini called Notebook. And what we actually do with Notebook is we put all of our incentive plan design information, all sorts of other materials, and we actually leverage the Notebook AI functionality, and people can go in and ask questions to the Notebook. So not only do we have our normal enablement and sales enablement and trainings and all the enablement materials that we have available on our intranet and that we actually present, we now have this new functionality where they can go in and literally ask a question about anything. And it actually is an amazingly powerful tool. From an incentives perspective, I mean, we have 20 or so people that's all they do is business partner to answer these types of questions. It makes them so much more efficient, so much more productive, and quite frankly, develops a self-service environment that over time, I think is actually going to make our operations even more efficient. So for us, like it's all about that enablement. It's all about that alignment. It's all about being in touch with the senior leaders and being agile. You have to be flexible. You don't always hit the mark. We changed all of our metrics a couple of years ago, and when we did that, it was like you had to change the way you approach things. And we didn't get it right the first time. We're constantly tweaking it.
We have a question here in terms of incentivizing on margin. versus, switching to margin from something more top line like revenue and bookings. Is there, in my experience, I haven't seen that quite often at all, but have you guys used it in the past? Are there any dangers or any big reasons as to why it's not used?
It's a component at Red Hat for our services business. A lot of our services business operates on margin because we'll use outside consultants frequently to deliver some of the services. So the cost of those consultants factors into the profitability on that contract. So we do have margin goals in that area of the business, and the hard part about that is predicting what those margins are going to be, right? It's because especially when you're using outside consultants in a dynamic environment, or in a competitive environment, it can be a lot more expensive in certain areas of the world. But we do use it as a component of our services incentive comp.
We don't today, but I will say of our two products, email and SMS, one is the SMS is margin hindering per se, because the cost of sending an SMS is much higher for us than what we're able to charge for it compared to emails. So we've talked about margin, but at the end of the day, it's the infrastructure cost isn't something that the rep can manage, right? It's our cost of doing this business. And pricing becomes more of an important component of how we're pricing SMS. But so all to say, we've discussed it, but haven't put it in place in any areas of our business yet.
We had another question come in that I think is interesting in terms of, let's say you're getting huge demands in terms of quota and targets to be hit at the senior level. When are there any times in your career where you kind of use I've heard it before of saying, the comp plan can't solve everything. How do you know when essentially you're perhaps maxing out how the plan can be designed, incentivized, the headcount planning that you have? What are times when you say, yeah, you turn around and just go, it's not us?
There's definitely I might be frozen.
We
Sorry.
can still hear you.
All right. There's definitely, I'd say, not just a diminishing, but a negative return on components that you add, whether that's core plan components or spiffs. We get a little spiff happy at times, and we get the feedback that then no one really knows what's out there and kind of pointless and distracts. And it's like, okay, you're motivating short-term deals, but you're also motivating large deals. And I don't know which one to solve for, so I'll just do what I was going to do anyway. So yeah, there's a tendency to lean on comp because it feels like something you can action in the moment. So I don't know if I have a good answer, a good rule, except to say that there are limits, and that sometimes performance is performance, and comp has its limits.
Yeah, I mean, and it depends on the market, right? Like, I mean, if you're already pushing the market, to gain share, and it sometimes it doesn't matter how much money you throw at it, right? I will say, having led our incentives department for a while, it's pretty rare to hear a salesperson say you can't solve it with comp. They tend to think you can. And we do a lot of we try our best to do a lot of postmortems on that to really measure like what kind of structure to compensation, whether it's a spiff or whether it's part of our base plan, what was effective. And like we've done that over the last couple of years, and we actually recognized that there are certain elements of our plan that we think are probably disincentivizing compared to the rest of the portfolio, certain types of sales actions. And that kind of analysis means a lot, right? Because if you really want to drive that, you need to make sure that certain things are happening. And there are quite a few outside consulting agencies that will help you to determine that, right? Like we've worked with a couple that have told us, hey, this part of your plan is weak in this area, bolster it up. But that's our biggest approach, is just a lot of those postmortems and making sure that you actually got what you paid for.
I agree. I think we looked back last year, and we had an annual measure that didn't drive at all what we expected it to drive, right? And so we evolved the plan this year to not have an annual measure on that metric, So we thought we could throw comp at it, and it didn't work as planned. So we learned, and
I mean, we've allocated money for spiffs for tens of millions of dollars and haven't spent it because it just what
Yeah,
the spiff itself didn't hit on the mark, you know?
yeah,
It's like,
yeah.
I don't even know how to I don't even know how to sell that. And it
Hmm.
wasn't an awareness thing. They just didn't know how to market it the right way.
I think
Hmm.
that actually brings me kind of what I wanted to cover next, and you talking about SPIFs. I guess all three of you mentioning SPIFs, but is there a rule of thumb? I'm sure the audience is interested. How much do you set aside at the beginning of the year? What is typical?
Go case by
You know,
case, which I don't recommend, but tends to happen.
with us, it's super situational. I mean, it really is. I hate to say it because, sometimes if you're not quite performing where you want to be, right? You have commissions or incentives savings, and so you tend to feel like there's money to spend on a spiff, right? But is it really the right money to spend? Is the question that we run into. We at Red Hat, we don't set aside any specific amount. What we do is we work with our sales leadership team, though, to say, hey, is there a way that this can pay for itself? Is there something else that we can do that helps to set aside, $5 million or $2 million or whatever the number might be, for this particular spiff? And, maybe it's in the services industry. It might be like, hey, there's an opportunity here. It's a very high margin area. Maybe we throw some money at it, to help capitalize on a certain, competitive advantage that we might have at a certain time. We do a lot of that. But we don't set aside a specific dollar amount. We try to work our best with the sales teams to work within their entire envelope, for a budget, and that's how we kind of approach it. That just changes depending upon where you're at in the cycle.
That's true for us too. I would just say it feels quite reactive to something that's happening in the business that we end up, putting a spiff together to change core systems, but don't
Yeah,
necessarily have a budget aside.
if you missed it in your core design, right? Like you
Yeah.
always feel like you should be taking into account these things that we end up having. And like I said, unless there's kind of a fault in the core design or a market dynamic that didn't exist at the beginning of the year when the original core design was developed, you really have to think hard about whether or not those are the right moves.
Mhm.
Great. Well, we're at the top of the hour, and I think we've tried to answer as many of questions in the Q&A. I think you guys have also, we've been answering them out loud, but also you guys have been very active in the chat, so I wanted to thank you. And I think we will wrap up the discussion here, but again, thank you to everyone in attendance. I think we had a great discussion today. Thank you to Mark, Steph, and Brian for joining. Really, really interesting points and really valuable to hear your perspective given your careers to this point. And I wanted to just note to everyone, we have our last session tomorrow as well. So stay tuned for that. But with that, thank you very much, everyone, for joining, and have a great rest of the day.